You, Michael, you're our fixed income guy. Quickly, anything you'd add?
Oh, the problem is the inversion of the yield curve. That will the Fed move quick enough to allow rates to come down? Remember, the beginning of the year, at the end of last year, the 10-year Treasury was around 3.9%, but there were 6 rate cuts priced in for 2024. So to get back to 4, you're going to need lots of rate cuts in the next 6 to 9 months. And as we just heard, it's very possible we won't get that many. Get a few, but not that many. So other countries have cash rates at 4 and 10-year bonds at 4. So you could see 100, 150 basis points of rate cuts and the 10-year Treasury hovering around between 3.90 and 4. All
right. On that note, then, Brian Rose, we turn to you. Still in the kind of camp that we have a soft landing and the Fed starts cutting in September. Do you see any risks to that? Do you think I guess put it differently, do you think we can avoid the labor market continuing to cool from here?
Oh, yeah, this is the million-dollar question. You can see from the Fed's rhetoric that they've become more concerned about the labor market. So, they've gotten what they wanted, which is a rebalancing in the labor market, a big drop in job openings without a lot of layoffs or sudden rise in the unemployment rate. But they recognize now that the labor market is back in balance. It's no longer overheated. And if demand for labor keeps weakening, there's a real danger that layoffs will take off and unemployment will go up more than they want. So this gives them a big incentive to start cutting rates sooner rather than later.
Exactly. Barry, how should people be positioned right now? We talked about this right off the top. Bob Pisani said maybe finally this rotation, the Mag 7's under pressure today, other parts of the economy, the banks, the housing areas doing a little bit better.
Right. Well, I've been underweight financials, small caps all year. I have been overweight energy, materials, and industrials. I reduced the industrials overweight. I've been market weight, tech, and communication services. But being overweight those sectors, quite frankly, is orders on recklessness because they're 40%.
But come on, the earnings growth?
Well, listen, 40% is still a pretty healthy position.
It is, but maybe they deserve that much of a percentage.
100% they did. And that's why, I've had that market weight on them. I think what's happening today is that position with, macro hedge funds, leveraged accounts, quant, momentum-oriented managers, they were all in on the tech and, underweight cyclicals, short cyclicals, small caps, and you're seeing an unwind of that today. But the fundamental justification for that trade is strong, as you just intimated. And I think what we're going to hear during earnings season is crucial in as much as last quarter we had 8% earnings growth, but ex-tech and comm services, it was 0.0.
Wow.
Right? Blutarski's grade point average. So this quarter, we're expected to get something more like 10.5 overall, but 7.5 ex-tech and comm services.
You mean, wait, are they 7.5 of it, or they're?
No, they're going to be 7.5% growth. So everything else, the other 9 sectors are supposed to grow 7.5%. What we heard from Delta today, from Pepsi today, it's not so clear. When you look at CPI, missing on things like big drops in airfare and lodging away from home, price tells you something about demand as well. And so I suspect that those numbers are likely to be disappointing. And by the time the Fed starts cutting, we could very well be saying they're too late. And it'll take a while for those fundamentals to start to turn, in which case, will it be time to pile into small caps right away? Probably not.
Yeah, you'd fade that. Brian, what would be the signs to you that, the Fed needs to get going in a hurry here? I mean, we talked about the labor market. Anything in financial markets that would say that to you? And what about the people who say, why start cutting rates when stocks are at record highs?
Yeah, this is clearly one risk. If there's a big market correction, if financial conditions tighten without the Fed moving, right? So equity prices fall or the spreads on corporate bonds widen out. That could give the Fed another reason to get going. And, I do see some chances of a more rapid Fed cut. So our base case is 1 cut per quarter. But with rates at this level, I think, clearly rates are too high. They need to be cut. And any sort of bad news from the markets, or especially from the labor market, and, the Fed could be cutting every meeting, or maybe cutting more than 25 basis points. And they have that the leeway to cut aggressively if they need to.
Michael, I'll give you the last word.
That's exactly right. There's a Fed put that if the rates are so high, they can easily cut 100, 150, maybe even 200 very quickly. Just as they raise rates very aggressively in the initial stages when they fell behind the curve, they could move very, very fast, which could re-bolster financial asset prices. But it is unusual to talk about the Fed cutting rates when credit spreads are at near all-time lows, equities are at all-time highs. Why would the Fed be aggressive in cutting rates besides just moderating how tight they are?
Do you think this will be more like, people say 1996 was a moment where we saw, policy adjustment that wasn't necessary, or there have been a few other kind of these mid-cycle moves, not necessarily end-of-cycle moves?
I think it's exactly what we're faced. Fed over-tightened in 1994, went from 3 to 6, realized it pretty quickly. We didn't need to go this high, cut rates 100, 150, then it was clear sailing for the next couple of years.